pre-qual all the way into closing and getting everybody paid on the loan. So, and everything in between. So we're kind of going to go through that. Just understand that this is kind of the general process. Any given loan can certainly have things that make it unique and different than where the process really doesn't change, but certain factors of the loan might take longer in a certain section of the process than others and whatnot. So all of that stuff might vary, but I'm going to share my screen. I can share my screen, right, Jody?
Yeah. Yep. Make sure you share video and sound.
Okay. Share screen. Let's see if I'm doing this right.
Perfect.
You see my screen?
Yep.
So I'll go from here. So life of a loan. So I'm going to start at pre-qualification, pre-approval. Obviously, this is the initial contact that our LOs will have with the borrower. So agent says, hey, can you please help out a customer that I'm starting to work with or that I have been working with, gives us their contact information. Our LO will give them a call and go through their situation, talk to them about how that the house that maybe they're looking at, or if they're not looking at any home, a specific home right now, what they might qualify for based off of their income, assets, all of that good stuff. So there's a couple of different things here. There's the pre-qualification versus the pre-approval. So I want to talk about that a little bit, and we'll start with the pre-qualification. To have an accurate pre-qualification of a borrower, we really need to have accurate documents from that borrower. Typically, our LOs are doing one of two things at the pre-qualification stage. They're either having a phone conversation, and then that borrower is ready to make an offer right now. Therefore, we're looking for a pre-qual right away. That's not the ideal situation, as we haven't had a chance to really look at any documents at that point in time. But we have the we're going by what they're telling us based on the numbers that they're giving us, running some numbers for them. They are, qualified for what they, for the home that they want to purchase, and we can issue a pre-qualification letter. In a perfect world, we'll have those conversations before they start looking for a home, get the documents from them, some income documents, be able to run their actual income, and or have them complete an online application so we have that application in our system, and then generate a pre-qualification for them based off of documents. The pre-approval is different in that we're collecting a full file worth of documents, and then without a property, moving that loan to an underwriter to look at the documents and sign off and validate the income. So on a pre-qualification, even when we have documents from the borrower, those documents are being reviewed and income is being derived by our loan originators and the sales staff on a pre-qualification. On a pre-approval, you're getting a commitment letter that's validating all of that information with the actual underwriter who's the decision maker. So that's really the big difference between pre-qualification and pre-approval. We do both. We do Jumpstart, which is our pre-approval program. What also happens at that point in time is if we can get them to go and complete an application on our online through our online application, we can get them to also complete what's our e-consent, the All Points Mortgage e-consent. And what that does is the e-consent is basically saying that the borrower will accept electronic disclosures from All Points Mortgage. Okay. So if they go through the application process online, that happens automatically as part of that process. If it's just a phone call and we need to send them the e-consent, they will get an email from All Points Mortgage saying, please e-consent to online documents. That e-consent will then allow us, once they do find a property, to send them the All Points upfront disclosures and allow them to e-sign those disclosures for All Points Mortgage. once we get a property under contract, so people find their property, we've pre-qualified them, they've made an offer, their offer has been accepted, we're now going to contract, right? We're now going to, at that point, as loan originators, we're going to collect their additional documentation, things that we don't have. So the more that we had up front, the less we have to collect at this point in time. Asset documents, obviously a copy of the contract, any income documents that may be missing that we did not have on the initial at the initial time. We'll collect those documents from the borrower, and at this point in time, we'll discuss the locking of interest rate. We'll talk to them about what the current rates are. I'm sure we had that conversation at the pre-qual stage as well. But at this point in time, they have a property. We can now talk about locking in their interest rate based off of contract closing date, how long of a lock period we may need, and what the actual rates on that day may look like, and discuss the locking of that interest rate if they want to move forward that way. What we also do at this point in time is we send the initial all points mortgage disclosures to them. These disclosures are intent to proceed, I believe, is part of that. Joanne, is that you're saying no?
No,
It's not. Oh, that goes out with the LE.
yeah, that goes out with the lender docs.
Okay, my mistake. A bunch of different broker upfront disclosures that go out at that point in time.
Yeah, it's just basically the 1003 that we already filled out, and a
Yep.
few other of the compliance documents. Just initially saying that we're the broker, and telling them that all of those compliance issues with that. So
Correct.
Okay, hang on.
Go ahead.
So now we're in the pre-approval, we wrote the offer.
We wrote the offer.
Okay, and what are some of the documents that you need from the borrower? Can you just say, like, let's say it's FHA. What are those documents?
What we need from the borrower to do the pre-qualification?
Yeah, so that the pre-approval.
All right, so if we're doing a jumpstart pre-approval, okay,
Is
we're
that,
going
am I
to
skipping ahead?
collect a full file. So we're going to collect all their income documents. We're going to collect 30 days of pay stubs, last 2 years W-2s, if they are self-employed, or if they are self-employed or are a independent contractor or something like that. We're going to collect tax returns. As far as assets, we're going to collect the last 60 days worth of assets to the last 2 months bank statements on all of their asset statements. We're going to collect, obviously we don't have a contract at that point in time. We'll review those documents. We may need to address any large deposits that are on those asset statements. If we do, we'll address it at that time. We will run a credit report. We'll look at the credit report. We'll address any late payments or any things that might be derogatory in that credit report, ask for an explanation letter if it's appropriate to get that. So those are the type of things that we'll collect up front on a pre-approval. On a pre-qualification, the income docs probably will be similar, although we may not need to see their W-2s if they're a salary borrower, maybe just their pay stub or a recent pay stub to verify what they're telling us, so that we know that we have income that we can use. It depends on their situation.
So if we're working with someone and we're starting to have a good conversation and the market is really hot right now, we would want to tell them to have these documents ready. We're going to need how many pay stubs?
30 days. So if they're paid every 2 weeks, which seems to be the most norm, it'd be the last 2.
Okay.
If they're paid every week, their last 4. Yeah. So
30 days.
Okay.
Okay.
All right.
And if they're self-employed only, they need the tax returns? What if it's FHA or CHFA? Do you need it for that?
CFHA, we need 3 years tax returns. So, but not
3 years,
FHA.
okay.
FHA, it's the same rule of thumb. If they're self-employed, independent contractor, if they're commission income, own more than 25% of a business, if they have rental properties, those type things will require us to get tax returns. So, if we can avoid getting tax returns, we do. We're trying to do things with the least amount of documentation possible to make the process as smooth as possible.
So if they don't have their tax returns, they can request them from the IRS?
transcript.
They can.
Yes, they can.
They can, yeah.
So-
Yeah, they can.
For their account-
Right now, that's hard to get, but yes,
Their
in the
accountant.
normal times, yes, they can do that.
Thanks.
So once we have all our documents and we've sent out our all points upfront disclosures, now it's time for what our LOs will do is they'll upload their file to Norcom. They'll send the file to Norcom, who is the ultimate lender on the loan. And that's where Amber Edberg, who is the processor for All Points Mortgage, will come in, and she'll be the other person other than the All Points loan officer that will be involved in that file. So there will be times when the borrower will certainly get communication or maybe even speak with Amber in lieu of speaking with their All Points LO, and same from time to time an agent as well. You know, Amber is very involved in the file. And knows the files very well. So she's the other person that will be involved right now on All Points Mortgage loans, you know, at least at this point in time. Norcom is the lender. So when Norcom gets that file and Amber gets that file uploaded to her, she will send out a Norcom e-consent to the borrower. This is where things can get a little bit confusing. But I think it's important that everybody understands that there's an e-consent that goes out from All Points up front for their disclosures. And then there's an e-consent that goes out from Norcom for their disclosures. And all that e-consent does is it's the borrower acknowledging that they are okay with receiving electronic documents, electronic disclosures, and signing electronically on those disclosures. That obviously speeds up the process. So if for some reason a borrower did not want to, you know, do electronic disclosures and sign electronically, we would have to physically mail those disclosures or mail them, print them, bring them, have them signed in person. They would have to what we call wet sign those documents, right? So which takes longer and can make the process longer, especially on the back end of the process when we get to this closing disclosure.
So can I just stop you again? Sorry.
Yeah, ahead. Yeah, absolutely.
So Amber gets it. She can't get them to sign it. Does she call the agent and ask for us to help?
Can't get them to sign the e-consent?
Mm-hmm.
Well, usually she'll go to the loan officer first. If the loan officer's having trouble, they can certainly ask the agent for help. I think in most cases that's not an issue. I mean, most of our LOs can explain and people understand they have to sign disclosures and stuff, and explain the time frames that are involved with that. But if need be, we certainly can get the agent involved, but we don't typically have to do that. I don't believe anyway.
Not usually.
The loan estimate at that point in time is sent out to the borrower. Once they e-consent, we send out the loan estimate to them. In that package, we have our some other disclosures. Our intent to proceed is one of those documents. They'll e-sign their package, and once they e-sign their package, Norcom automatically gets notified that that's been e-signed, and at that point in time, we can order the appraisal. How that works, in case people are wondering, the intent to proceed is basically the borrower saying, yes, it's their written attest. They're attesting that they are going to move forward with this deal. And at that point in time, the law allows us to collect upfront money from them, which is what we do when we order the appraisal. When we order the appraisal, we will typically run their credit or debit card through the online ordering of the appraisal system. And basically at that point in time, we're taking upfront money from them for this loan. So that's why the intent to proceed is important, that we get that back and signed.
And typically, what's that cost?
The appraisal, a single family regular appraisal is, I believe, $495.
Right.
You know, if it's a two family, it could be more. If it's a unique property, it could be a little bit more. If our timeline is really short and we need a rush appraisal, it could be a little bit more. So there are things that will sometimes dictate the cost of the appraisal, but run-of-the-mill single-family home, the $495. At that point in time, Amber also orders title work. She will also look and see who the settlement agent is on the file. Who in Connecticut, we're an attorney state, so we'll look to see who the attorney is on the loan that's going to be closing the loan for the borrower and make sure that they're on our approved list. If they're not on our approved list, she'll start that process to get them on our approved list moving forward. So we're addressing, you know, title work and settlement agent right in the very beginning of the process to make sure that that's not something that's going to hold us up at the end. She'll review the file, make sure that everything that is supposed to be in the file is in there. She's kind of that, you know, next set of eyes other than the loan originator to make sure that things that are in the file are in there. And then time frames for when all of this is happening, just so everybody understands. The loan officer is going to upload the file to us within 24 hours. From the time that we have 6 pieces of information, so income documents, property address, you know, borrower name, social security number, all of that good stuff, we have 3 business days to get a loan estimate out to that borrower by law. Our all points LO takes up can take up to 24 hours to get that file uploaded to Norcom, and then Norcom has the second 48 hours, if you will, of those 3 days to get those disclosures out to the borrower for signature.
And what is a QST?
QST is our quality service team. So once the loan is reviewed by the processor, she moves it on to QST. And what QST does is they review that file before an underwriter does, just to look at it and say, hey, based off of what's in the file, we feel that the underwriter is going to need A, B, and C on this. It's basically a pre-underwrite review. And what that does is it allows our loan officer and our processor then to go in advance and get those documents from the borrower. We can with that knowledge, we can then go to the borrower and say, hey, our quality service team says that we're going to need, you know, an explanation for your income, or we're going to need a whatever. We were missing last year's, you only had 1 W-2, we're missing a W-2, you know, something like that we probably would have already been asked for, and say, we need this stuff, can you please work on getting that to us? So in a perfect world, we'll get that stuff before the underwriter review, so it's not a condition on a loan. But if we don't, and it ends up being a condition on the loan, it's not a surprise to those that are involved in the borrower. So it's kind of
At this point, do you loop the agent in to let them know what's going on?
Do we loop the agent in? I'll ask you. I'll defer to the LOs. How transparent are we on when things are being submitted and all that good stuff?
I typically,
Sure.
when I'm asking for documents, I will copy at the very beginning. I will copy the agent to say, these are the next steps, just so they know that I've contacted the borrower, I've given them the next steps since I've gotten the contract, and then any other documents that are outstanding, I typically put in there so that they're aware that there's something outstanding. Throughout the process, every single document that's outstanding, I don't copy, you know, the agent, just because I'm sure they don't want to get inundated with every little email that we send out to the borrower.
Yeah, and we definitely do update the agent on the I guess big milestones throughout the process, right? So appraisals being ordered, loan being submitted, obviously approval, clear to close. Those things we're certainly looping the agent in on, and there are notifications that will go out to the agent on that stuff. If not also through the LO directly as well. So, you know, every little step along the way, not maybe like pre-underwriting QST is not something that we'll normally loop the agent in on. It's just part of our process. That's kind of a quality service part of the process. So, and it's not something that takes too long. It can take up to 24 hours during high volume periods, but usually it's done in the same day that they get it. They review it and move it on to underwriting. Our pre-underwriting QST also there is no stop at that point. It's a set of eyes. They issue a report back, and they keep the file moving on into the underwriting queue to be looked at by an underwriter. So once pre-underwriting QST is done with the file, that, like I said, they move it into the underwriting queue. It'll sit in submittal until an underwriter reviews that. typically our turn times, at times of low volume are 24 to 48 hours. Right now, as of today, as we stand, our underwriting turn time is five business days. So it's certainly longer than the normal, and that's just a product of volume at this point in time. So that's something that will change daily, depending on volume and stuff. Although we've been at 5 days for a little while now, but underwriting turn times obviously vary based off of volume. When the underwriter reviews the file, they'll issue a conditional approval, and a commitment letter is generated at that point and sent to all parties. Okay, so
Who are the underwriters?
Who are the underwriters?
Yeah.
You want their names?
I'm just curious.
There's a bunch of them.
There's a bunch of them. We just hired two more this week. So, I mean, I could list names, but I mean, it's not important. But we have right now, I believe we have 10 or 11 with the two that we just hired. So we have a decent underwriting staff that is working really hard and keeping up with the volume that we're dealing with right now. So we're really fortunate. We have a great operations team all the way around. Some of the typical conditions we'll see on our commitment letters that you'll see is appraisal. Even though the appraisal has been ordered, we will issue the commitment prior to the appraisal coming back. So obviously, if the appraisal was back already and was there where the underwriter reviewed it, that wouldn't be a condition of the loan, but we will see loans approved subject to the appraisal. Title work usually is not in at the time of approval, so we'll see that be a typical condition that needs to be reviewed. If the loan is greater than 80% loan to value, we'll see mortgage insurance if it's a conventional loan as a typical condition. HOI is homeowner's insurance. If there's a large deposit, you'll see that as a condition that needs to be explained and documented. And I threw in there too, with times right now of some of the stuff that's going on around, the COVID temporary restrictions and stuff. One of the things that we are asking for now that we probably, that we weren't during normal times, for lack of a better word, is we continue to want to update their pay stubs. So we're really telling borrowers right now that every time they get paid, they should be forwarding those pay stubs on throughout the whole loan process to their LO. Because we're going to always need their most recent pay stub along each step of the process. And the reason for that is with so many people losing jobs and getting reduced hours and getting furloughed and all those good things, we have to make sure that our borrower is not having any of those events happen to them throughout the process, and that they're still gainfully employed and earning the money that we're qualifying them to make throughout the process. That's not something that we in the past have typically needed to do, but it's under the new guidance of our investors, we need to be doing that.
There's a question in the chat from Tracy.
Sure.
She's asking, are there routine communication touch points for the LOs to speak to the clients to keep them in the loop as well as the agent?
Yeah, so I'll let the LOs, if any of you guys want to jump in on that. I mean, I know them, but I'll let you guys jump in and answer that.
Yeah, we usually reach out to them as soon as it gets approved. When we get the appraisal in, so when we get the appraisal in, they automatically get an email saying that that the appraisal's in, and typically we'll let the agent know at that point too. And then same thing at approval. I mean, sometimes there's documents that we need from the agent for approval too. So we'll reach out and say, hey, we got the approval. We need, property disclosures or something. And then, we'll work on the conditions. I mean, sometimes no news is good news. So, if it's sitting in underwriting and we're just waiting for it to go through underwriting, then, there's no news to report. It's still in process. Other than that, I mean, those are the main points that we, times that we reach out, and then again, that final commitment.
Yeah.
So I'm hearing when you take the application, then when appraisal goes out, and then when they get approved, those are the 3 times?
Well, we typically
Oh.
try to contact them, weekly, touch base, try to, as long as, make sure that they know that there's, if there's nothing going on, we try to do that. I mean, depending on volume and day, I try to pick a specific day of the week to contact people, even if there's nothing going on. But definitely at the point of the appraisal, at the point of conditional approval, Amber, I just literally sometimes tell them that they're conditionally approved, and Amber will send them a list of conditions, and then we go over them, if they don't understand them. But that's then even after that, that's when a lot of times there are documents that are needed, and there's a lot of explanation needed in between, depending on the complexity of it with the borrower. And I don't think that's necessarily a point where we're letting the agent know, that they need to show that their $1,000 cleared in their bank account from the EMD check. I don't think that, there's a lot of that going on back and forth with borrowers, and things that are missing, or little things that may have been missed along the way. So there's a lot of communication back and forth with borrowers it seems like a daily basis, when they're conditionally approved.
Okay.
And then obviously we're letting the agent know at clear to close and on the back end of things, right? So, hey, we got the clear to close. We're, they're going to be scheduling all that good stuff like that. Those are the calls that obviously everybody's waiting for. So those calls.
Yeah. I think there's constant communication, and I think also setting the expectation with them as well. Just saying, look, here are the steps, and here's what's going to happen, and just so they know kind of what to expect, and not sitting out there waiting.
Yeah, absolutely. So once we have our conditional approval, now it's we need to clear whatever underwriting conditions there may be on that approval. So we'll obviously have conversations with the borrower as to what we need. We'll give them a list of the conditions that we need from them. We will collect those documents from them. The processor will get those documents over to underwriting. An underwriter will review those documents in 24 to 48 hours, and then clear those conditions, assuming that the document that we gave them is what they were looking for. And then at that point in time, we will issue a final approval. All right, that our final approval is kind of a pass-through milestone for us. At final approval, basically what that says is that all conditions on that from that commitment that were underwriting conditions have been satisfied. There still could be conditions of the loan at closing. An example of a closing condition could be if they are selling another home while they're buying this home, and we need to see the closing disclosure that they closed on that home first. That would be a closing condition that our closers would get right as our loan is closing with them. So those are so not to say that there couldn't be a closing condition. It's more rare to see closing conditions that we have to deal with. But there could be some closing conditions on a file depending on the situation. But the final approval says all underwriting conditions have been satisfied. We're moving that file onto the closing department, onto the next step at that point in time. If the file was selected for quality control, we do have a 10% of Norcom's overall files need to get selected for pre-funding quality control. So sometimes, a lot of times these files will be selected randomly. We don't select these loans until they have a conditional approval and a commitment issued on them. So we'll know usually within a day or two of that conditional commitment if it has been selected for quality control. Quality control will review that file within 24 hours of the final approval being issued. And if we have a quality control condition, we'll get it over to them. But typically, it's just another set of eyes that's looking at that file and making sure that all the documents that were supposed to be in that file are in that file. We also have a pre-closing QST, which is just like the upfront on the pre-underwriting. It's a second set of eyes that look at that file, make sure that all the documents we would need for closing are in that file. So settlement agent approval information, settlement agent documents, title work, all of those things that need to be in the file are typically there. It's really a check on the processor to make sure the processor got everything they needed, so that when the file does get over to the closer could be very efficient and then close the loan. The clear to close is then issued, and at that point in time, we can now schedule your loan. Okay, we can schedule your loan for closing. I'm going to back up just a little bit, because while this is all going on, we also have our closing disclosure process. So a closing disclosure, as many people on the call understand, the closing disclosure is a disclosure that basically replaced the old HUD-1 document that is the closing statement that shows all the fees that the borrower is paying, that the buyer is paying, that the seller is paying, who the interested parties are on that loan, so who the loan officer is, who the agents are, both listing and buying, who the attorneys are, both buying and selling, all of that information is on the closing disclosure. It's several pages long. I think it's 5 pages long, and it has all that information on it. There's a law that says that the closing disclosure must be received and signed by the borrower within 3 days of closing, of the actual closing date. So what we try to do is not wait until, in a perfect world, not wait till the file is clear to close to issue that closing disclosure out to the borrower. The sooner we can get that out to the borrower and signed by the borrower, the sooner that clock starts ticking on the 3-day rule for when we can close. So if we can get beyond that 3 days before the loan is clear to close, technically we can now close that loan much quicker once we have the clear to close issued. We can close that loan, well, in theory, as soon as that day, but certainly the next day or the day after, and not have to worry about a 3-day waiting period at that point in time.
That is so cool. I never knew that.
So what our system does is we have an automated initial closing disclosure that gets triggered. So once we have a conditional approval, we have an appraisal, we have the title work, we have approved the settlement agent, and the loan is locked, and we have the settlement agent documents. There's certain documents we need from the settlement agent as well. Our system will trigger internally, will trigger the initial disclosure. And what that does is it basically assigns a closer in our closing department. Even though the file may not be in closing yet, it'll assign a closer, and the closer can then within 48 hours, get out the closing disclosure to our borrower. So the loan may be conditionally approved. We may be working on conditions at this point in time, and then the borrower could get their initial closing disclosure sent to them for signature. They will get additional closing disclosures sent to them. Usually the initial closing disclosures still have mostly estimates on them, because it still is, I would say the middle of the loan process at that point in time. But we're trying to, the reason why we're issuing that disclosure so far upstream is we're trying to eliminate that 3-day wait at the back end, so that we can close that loan quickly once we have our clear to close. Sometimes we need to do that. Sometimes we don't. I mean, every loan's timeline can be a little bit different. We certainly have had loans clear to close where, the closing date was still 2-3 weeks away. And, that was the contract date. Sometimes we close early. Sometimes, given the situation with the settlement agent, we can't. I'm not the agent. I'm sorry, with the seller or buyer, we can't. But we also have those loans where time is very short, and we have a clear to close issue today, and we may need to close tomorrow because that's the contract date, or 2 days from then, that's the contract date. So getting that initial disclosure out and signed by the borrower as early as we can eliminates those waiting issues on the back end. Okay. So the closing process, once it's clear to close, a scheduling email goes out to the settlement agent. So we'll deal with the buyer's attorney at that point in time to schedule. They will confirm a date and time for that closing, and the closer will then work with the settlement agent on getting the final closing disclosure prepared. that involves a lot of back and forth between the our closer and the settlement agent for adjustments. As we know, there's a walkthrough typically a day or two before the closing. And at that point, usually we'll get adjustments. Once the walkthrough has been done, we'll get adjustments from the settlement agent to our closer. And at that point in time, we can generate a final closing disclosure and final documents then will be issued to the settlement agent. Typically, in most cases, that's done the day before closing. So if we have a borrower that's like, I need final numbers, I need final numbers, I need final numbers, which is typical. They need to know how much money they need to bring to the closing. We will typically have those final numbers for them the day before closing so that they can go and get a check or do whatever it is they have to do to get that money prepared for the closing. If it's a rush closing where we're doing a same day closing or the timeline's very short, in rare situations that could the final CD could be done the day of the closing. Typically that would be in the morning of an late afternoon closing type of thing, where the docs, but it's typically a full day, if not more, for the borrower to have final docs and numbers. One thing that we're dealing with right now, again, temporarily due to COVID, is the pay stubs. As I mentioned, we want pay stubs from the borrower throughout the process. We are required right now to get a pay stub from the borrower, the most recent pay stub. So if the closing day happens to be a payday for one or one of the other borrowers, we actually will need their pay stub that day before they can close the loan. If it's the day before, then we'll need it, then if it's, if they close today and their next paycheck is tomorrow, then we don't need to worry about that.
Nope.
Did you just look at this?
He got muted.
You muted me.
I'm trying to mute my.
Now you.
Am I muted still?
No, Jody is.
Oh. And then the loan closes and everybody is paid and happy, right? That's what everybody wants. So, questions. I'll read.
You must have done a good job.
Jeez.
By the reaching
Tom,
communication.
I do have a question. This is Tracy Everson.
Hey, Tracy, how are you?
I'm all right. How are you?
Good.
So given there's multiple offer situations, I've encouraged my clients to go as far as they can in the application process. Is that something that the loan officers are also trying to suggest so that you can really jump on an offer?
Yeah, so you're saying like try to basically let's start the process, head down that road of, I guess would be a pre-approval, so that we have as much as we can. We can shorten the timeline slightly on the overall mortgage. I guess that's what you're suggesting. That is something I think we should be doing, especially in times like this where inventory is a little low and multiple offers seems to be the norm. I don't want to say issue, but it's also times a high volume right now for us, I know, and I think most mortgage companies. So what happens with pre-approvals is they're not prioritized because obviously we're prioritizing files that have addresses tied to them, but we can certainly start that process and collect those documents and start down that road so that if nothing else, we have what we need and we can move quickly to the next phase. So I do think that there's value in doing that for sure. Absolutely.
Question from
Thanks.
Jill. She wants to know, why is it better to go with a mortgage company versus a bank?
Why is it better to go with a mortgage company versus a bank? Well, I think there's a couple of reasons for that. Listen, everybody has their strengths and weaknesses, I think, when it comes to certain things. With a mortgage company, that's our business. Doing mortgages is our business. With a bank, that is part of what they do. But what really makes a bank run is deposits. And with banks, you're dealing with a lot of cross-selling, and their mortgage department is, in most cases, a small part of what's important to them. All we do is mortgages. That's what we do. That's what we're experts in. With a bank, you're going to get varying degrees of expertise from their loan officers. Their loan officers do not need to be licensed. They have exemptions through the Fed to not be licensed. Our loan officers are licensed, which means they have to take a 20-hour course. They have to pass a test. They have to get licensed both federally and state for each state that they're licensed in. They have to do continuing education and all that stuff every year, just like you guys do, to be licensed real estate agents. So I would liken it to, if there was another way, if banks could sell real estate, they would have real estate people that work for them that aren't licensed and don't do all of the training and all of the things that they need to do to keep up with continuing education. It's the same concept on the mortgage side. Our mortgage professionals are licensed and need to do the things that they need to do to continue to be licensed, just like you guys do to stay licensed. The only place I ever see a bank has an advantage over a mortgage company is when they lend on a specific product that's in their portfolio. And the only time that we really kind of see that come to light more times than not is when we're dealing with jumbo mortgages and stuff like that, where they can put those loans in their portfolio. We're a mortgage lender, so we don't have the ability to have a portfolio and do those type of things. But I can tell you this, our menu of product is certainly going to be larger than theirs. But if there's a specific product, and typically when I say that, we're talking about jumbo loans. That's probably where they may have an advantage over a mortgage company. But outside of that, I hope that helped to answer the question.
I'd also weigh in, having worked for a bank for a long time, they can be a bit more conservative. The overlays can be really restrictive. And honestly, I'm not sure their pricing is always as good. I've gone up against my old employer a few times lately, and we're typically a bit better. And I think Tom's got a good point. The underwriting and the process, I've always said, is a make or break issue with this whole thing. And this is just far and above better. And I've also been on the phone a couple of times lately with people who have been chatting with banks, and the lack of questions that they ask and getting to the heart of really, what's making up the loan and sort of the pieces of the puzzle, if you will. I think Tom's got a good point in terms of the licensing and the knowledge that has to go into it versus somebody who's just potentially sitting in a call center taking a call.
Yeah.
But that's.
So we have had some questions in the past where somebody was asked for something.
Yep.
And they didn't really understand what they were being asked to do, and they might reach out to the agent and can you explain it? So if something like that happens, who do we call? The processor?
I would start with the originator. I mean, the processor certainly can, but I would probably go to the originator as the first point of contact on any questions as to why a document may be needed for whatever reason.
So
I can tell you there is always a reason.
Right, of course. So when Amber sends something out, does she call them or does she email it? How does that usually happen?
You guys deal with Amber every day. So.
She typically emails the conditional approval with the list of conditions. Then she also is very good about, if there's no response from the borrower or whatnot, she will call. Or if there's some difficult conditions, they're hard to understand. She'll reach out. And the borrowers sometimes reach out to her as well, seeing her name on the email. So it's sort of like a team effort, and we all kind of work together to get that done.
Nice.
Yeah, I mean, I've been on the phone with the borrower, and they said, I just hung up with her, and the woman works night and day. I had emails from her at 7:30, 8 o'clock this morning, and at 7, 8 o'clock at night. So she does not quit.
Yay.
Tom, can you talk a little bit about, for a lot of the newer agents also, holdbacks? I know when the CDs started about 4 years ago, lawyers didn't want to do holdbacks. They don't want to change paperwork. What do we do? Like, we go through a walkthrough and there's damage or something, and the agent goes to the lawyer and says, look at, there's a fireplace missing or something, that was supposed to be there that's not there. We want to hold back $1,000.
So like an escrow holdback or something along those
Yeah.
lines. We have a process for that. Typically something like that, depending on, I do think a lot of that stuff gets worked out outside of involving the mortgage company in a lot of cases, because once you bring the mortgage company involved in that, depending on what it is, it can become more of a process. So if there's damage to the home, then we're going to hold money back on the mortgage end to make sure that gets resolved, and then send somebody back out to the property to make sure it's been taken care of. We've dealt with that in the past. It's not an issue to do that, again, depending on what it is, but if it's something minor, or something that we have to address or hold money back on, we can do that. We'll work that out between the closing, the attorneys, and our underwriting department to make sure it's an allowable, that we're allowed. At the end of the day, nothing really can happen without our underwriters saying it's okay. So for something like that, we would typically have to go back to an underwriter and saying, here's the situation. This is what we, uncovered. Are you okay with us holding back an estimate of X, or we have an estimate to get that done that's going to cost this, and we're going to hold back the, whatever, typically it's 1.5 times is what they'll want held back on something to get fixed, whatever the cost is. And they'll say yes. Our closers will then, we'll hold the money back, and then we have a servicing department that will facilitate the appraiser going back out to sign off on that. Is that what you're talking about, Charlie?
Yeah, well, it's usually, a lot of times the attorneys I know will say, we don't want to deal with a holdback. You guys get out. And they say, we can't do it. And it becomes a problem. And, sometimes buyers say, look they said they were going to leave, the pool equipment, they're not leaving it, and I'm not going to close. So what do you do? The lawyers say, work it out. But I guess the question is, so if we do say, if the agent has a problem and they want to hold back, do they call the loan originator or call the processor? What do they do? Or the attorney does?
Yeah, I think typically it'll go to the attorney first, and the borrower and the attorney will decide on what they want to do.
Okay.
I do think a lot of that stuff gets worked out without us being involved in it.
Yeah, they try to, but there's sometimes where they just, there's.
Once you're bringing the mortgage company involved, it's going to have to go back for underwriter approval typically, right? Depending on, in most cases. So if we're at the point of where we're ready to close and everybody's like, all right, we're going to close, we have to now go back to an underwriter, get approval. So not to say that doesn't, that couldn't get done even same day of the closing. It can, and it has. But if it's a 4 o'clock closing and now I got to get back to you're just muddying the waters a little bit, and you're adding more people into the mix. It's not ideal, but it can get done. We have a process for it, but just knowing that when that does happen and we're involved, it's going to have to go back to back in the process a little bit for approval. Okay.
All right. Thank you.
Yep. I think Tracy has another question. I'm looking at the chat. What's the response to a client who says, I spoke to Quicken Loans and they said X? Quicken specifically, or just anybody?
Let's run through it.
So, I don't know, Tracy, if you wanna jump on and just ask. I take that as Quicken being a call center, but I don't know if that's how you're asking the question.
Yeah, exactly. I had a client who said, well, I spoke to Quicken Loans, and I said, well, I just want to let you know that I've had clients who have gotten much better numbers after speaking to a loan officer with ALLPOINTS. So I tried to bring them back into the fold because everybody's thinking, oh, this is going to be easy and quick, right?
Yeah. So with Quicken or there are a lot of online and call centers out there that are trying to jump into the business. And what you got to understand what you're getting with a call center loan officer versus, you know, someone that's out in the field. It's very different. And I know you guys understand that, because I think you see it in your business too, right? There are online companies that say, I'll list your property and only take an X for a commission versus, you know, someone else. You kind of get what you pay for. So is it possible to close without any problems with an online call center? Absolutely, you can. But you're not getting the expertise of someone that that really knows what they're doing. You're getting someone that just churns out loan after loan after loan, and it's kind of an assembly line for them, and they know what they know. Believe me, if an LO is a really good LO, they don't work in a call center. They can make a lot more money working out on you know, in the field as a loan officer, you know, outside of a call center. So if they're in a call center, they're there for a reason, more times than not. And I know you guys see that with online companies that try to undercut your services as well. But in a lot of cases, their rate isn't even better. Their service certainly isn't better. So, you know, if someone's saying, you know, I heard this from somebody, or they're saying I got a rate from this place and they're giving me X, the first thing we would say is we'll get a loan estimate from them so we could look at it and see what they're really charging you. Because their rate may be 0.25% lower or whatever, but when you look at the loan estimate, you realize that they're charging a high underwriting fee, or they're in essence charging points for that loan without calling them points. And we can usually see that by looking at a loan estimate at times. So, you know, that would be the first thing I would say, is that if it's a rate issue, is get a loan estimate from that person, and then let our person take a look at it and see if we can do better for you, for sure.
You know, Tom, I just went through this twice with them. One on Sunday, it was a refi. Gentleman's going through a divorce. It was never brought up and never asked. And that's, you know, a key bearing point, you know, for what we're doing, and something you have to look for. And it never even got brought up. And I was just on the phone this morning with someone else. And one of the properties they have is an investment property. It wasn't even asked. So, you know, it can make a significant difference. And in terms of rate, in that case, we were an eighth lower, and I think it was a 0.5 point less. So even from a rate standpoint, we were better.
A lot of times, these issues that sometimes come up as surprises, and I know all the agents on this call have seen it, where at the 11th hour, something gets revealed that nobody supposedly knew about. And that really starts because the interview itself up front at the time of application wasn't complete and thorough. Borrowers don't know in a lot of cases that it's important that we know that if they own other property. They don't know that it's important that we know that they've been divorced. They think sometimes that that's not our business and that they don't need to tell us those things. But if they're paying child support or alimony and stuff like that, sometimes that's, you know, that's the kind of stuff that we need. Those things are really built into the loan application, but it's still, those are things that if you're doing a thorough interview with the borrower at time of application, those things will be revealed at that time, and we can advise them up front on how we deal with certain things and what needs to be done to get past certain issues.
Yeah, I mean, the woman this morning, smart couple, she's an attorney. They bought a new primary home in February, and last summer they bought a 2-family investment property, and they're refining both. It was a referral to me from her father-in-law, who I had as a client years ago. But she said, we've been talking for the last 5 or 6 days on this. She said, you know, I just did 2 loans in the last year, and I've learned more, you know, over the last few days in talking than I did in going through the whole process with these last 2 loans. It just, a lot of these questions never got asked. She never understood it. And she felt a little blindsided. Now it's like all sort of crystal clear. So a lot of it's an education.
Yeah. Any other questions? I will have this presentation, by the way. Jody, should I send it to you and then you can get it out to everyone on the,
Sure.
yeah, that's okay? Okay, I'll send you a PDF version of the presentation.
Yeah,
just
this was
in case.
awesome. Thank you so much.
Yeah, sure.
I learned a lot.
You learned?
I did.
All right, well, that's good. Very good.
Thank you.
I knew
All right,
everything.
guys, thank you.
All
I'll make
right,
sure Jody
everybody.
gets that presentation. And then if you have any other questions that you might think